Now let's talk about how you can save taxes while investing,
Sure.
right? And when it comes to investing, there is this rule that you have to follow that depending on when you need the money for,
Right.
you should invest in the right products, right? So let us say I want to save for going to Bali next year.
Okay.
Can you tell me how I should invest my money and pay the least amount of taxes when I actually withdraw that money to go to Bali?
Awesome, Sharan. So you're talking about your short-term goal, which you want to go Bali next year.
Yes.
Okay. Let's understand that you want to go exactly after 12 months
Yeah.
for ease of convenience. Okay. Now people have two options. Either they have FD or a debt fund. But the interesting option for you, because you are in a higher tax bracket, is arbitrage fund.
Yeah.
And it is I am going to explain with an example how much it would be beneficial.
Okay.
Okay. Let's say you are investing 10 lakh rupees in arbitrage fund versus you are investing 10 lakh rupees in FD. Let's show the math of FD or a debt fund. Okay, you invested 10 lakh, approx return is 7%. So after 1 year, you get 10 lakh 70,000. But 70,000 is your interest or a profit from your debt fund. Okay, on that, Sharan, thanks to the 30% tax you are in. Okay, even you are paying more than that, but let's assume 30% tax. 21,840 you have to give to the government.
Correct.
Okay, so your pocket will have that much less amount and not 70,000. This is a simple math.
Yeah.
Now, if you are investing in an arbitrage fund, more or less you get the same kind of a return. Okay, arbitrage fund is nothing. If you are investing in let's say fund manager, when you invest in this mutual fund company, fund manager invest into stocks and they hedge it or do arbitrage between the cash market and the future market. Okay,
Yes.
just to simplify that. Now, you have invested 10 lakh rupees into that. After a year, you have let's say 10 lakh 70,000 rupees. Okay.
Yeah.
Now, this 70,000, Sharan, because you are redeeming after 1 year, which is after 12 months, would be considered as a long-term capital gain as per equity. And because of that, you will not pay any tax because up to 1,25,000, there is zero tax. So all the 70,000 you can keep in your pocket, and maybe that 21,840 will sort out for 1 or 2 days of your nightlife in the Bali.
I like it. So basically, it's now possible to invest for your vacations and pay zero tax.
True.
Right? And most people are just keeping that money in an FD.
Right.
And paying 30% tax if they are in a very high income bracket. And most people are not aware of this option.
True.
Now let's talk about something that I want in the next 3 or 4 years.
Okay.
Let's say, for example, I'm saving money for my wedding and
Okay.
I added 50 lakh rupees. How do I save for my wedding where I'm going to spend 50 lakhs and pay very little taxes? Because I want all the money for my party.
Wow.
Yeah.
Okay, Sharan. So typically when you're investing money for, let's say 3 to 5 years, Sharan, you have a few options in terms of debt, which is your debt fund, FD, or let's say bond. And let's assume, again, I know you're going to spend a lot on your wedding, I guess.
Just 50 lakhs.
Okay. But let me give an example very simply. 10 lakh rupees. Okay.
Oh, fine.
Okay. 10 lakh rupees.
I'll have to ask, but okay. Okay, got it. Fine.
So right now let's start with 10 lakh rupees. Okay.
Okay.
So because it's easier to calculate. That's
Okay.
it. So 10 lakh rupees, if you are investing in a FD, bond, or let's say debt fund, roughly you can get, let's say 8% return per annum. So you will have 14 lakh 70,000 rupees after 5 years.
Okay.
But Sharan, you have to pay tax on all this as per your slab rate. I'm assuming again 30% tax, which means you will pay 1,46,640 rupees into taxes out of 4,70,000.
Wow.
Out of 470, you will pay 146,640 into taxes. Now, let's say you are investing into equity savings kind of a mutual fund, multi-asset mutual fund, or dynamic asset allocation fund. These are typically mutual fund, has equity, debt, and some portion of arbitrage and all that thing. This is a very popular mutual fund category, but many people are not looking from the tax perspective. Because Sharan, when I'm investing, I need to take care of two aspects. The first is risk adjusted return and the second is tax adjusted return. And most people fail at both. Okay. Now, let's say I'm investing 10 lakh rupees, Sharan. The first benefit here, you can expect around 10%, 9 to 10% return on all this product when you're investing for 3 to 5 years. So Sharan, after 5 years, the amount you will have is 6,10,000 rupees. Okay. In FD, I had 1470. Here I have 1610. That's the first benefit.
Sweet. 6,10,000 is the profit.
Profit, of course.
After
So
5
that's
years.
why 16,10,000 I'll withdraw.
Yeah.
And 6,10,000 is the profit. On that, I have to pay 12.5%. But on first 1,25,000, I'll pay zero tax because every year you will not pay any tax on 1,25,000 of long-term capital gain.
Correct.
Now, the tax you will pay here, Sharan, on 6,10,000 is 63,050 rupees to be precise, versus 1,46,640.
Wow.
So you have roughly 90,000, 80,000 higher than the FD.
Wow.
Now, something nobody is thinking at your level of income, for example, or anyone who is having income of 45 lakh or a 90 lakh around. Why I'm specifically talking about this kind of a population? Because your income can go above 50 lakh rupees or 1 crore. Now you'll have to pay surcharge on all the income that most people are not considering, because you cannot control, even if you are, let's say, investing in a cumulative FD, you have to pay tax every year because that interest would be credited in your bank FD. Okay. And because of that, you cannot control when you want to withdraw, and your income is near to this surcharge level. So we have one client, income is 1.8 crore. She got roughly 20 lakh rupees as an interest from FD bond and all that thing. Because of that, because of her income crossed 2 crore, now on all the income, she has to pay surcharge. That
Wow.
can be as high as 25% over and above your tax.
Wow. So,
So-
if you make more than 2 crore, you have to pay another surcharge on your
Of
tax.
course. If you cross 50 lakh, there is a surcharge of 10%. If you make more than 1 crore, there is a surcharge of 15%. Once your total income crossing 2 crore, there is a 25% surcharge.
So my 30% income tax will become how much?
39%, Sharan. So
I
people
pay
say
39% tax.
you are into 39% tax bracket. If you are in the new regime, if you are in the old regime, you are paying 43% tax, Mr. Sharan.
Why?
Because the surcharge, there is a surcharge above 5 crore at 37% in old regime. So if you are in old regime, your surcharge can be as, the total tax is as high as 43%, but in new regime, it can be as high as 39% and not 30% or 33%. So that's the tax.
This is why I take zero salary. This is the learning. So now tell me about long-term investing, right? Like when I'm saving for my retirement, when I'm
Okay.
saving for my kids' future,
Okay.
and pay zero taxes or minimize my taxes while I'm investing for that long-term goal.
Sharan, so let's say when you are investing for a long term, there can be many options. But let's talk about the professionally managed options. It can be a mutual fund.
Yeah.
It can be a PMS also.
Yeah.
Mota moti, it looks same because there is a fund manager in the mutual fund and there is a fund manager in the PMS also.
Yes.
But let me show an example how the tax would be there and how one should select the any product by keeping at least taxation in mind. Okay. So let's say, Sharan, you are investing 50 lakh at one go because PMS takes minimum 50 lakh rupees.
Yeah.
If you invest 50 lakh rupees, every year your fund manager in the PMS will do certain buying and selling. Okay. In your demat account, your PMS manager will do certain buying and selling. And let's say he has generated 5 lakh rupees of profit. You are happy.
Yeah.
Okay. But government is also happy because you will pay 20% tax on that short-term capital gain. So on 5 lakh rupees, you will pay 1 lakh as a tax. Now the bigger problem, you have not withdrawn anything from the PMS, Sharan. Your 50 lakh rupees of PMS has become 55 lakh rupees because there is certain profit booked by your fund manager. You are happy, you are getting 5 lakh as a profit. But though you have not withdrawn anything, you will pay 1 lakh as a tax when you file return.
Right.
That is first thing. Okay. Now let's see a second year. Okay. Second year from 50 lakh, 55 lakh. Again, your fund manager has generated 5.5 lakh rupees of profit. So your total portfolio from 50 lakh started. Now it is 60.5 lakh. Again on 5.5 lakh, Sharan, you will pay 20% as a short-term capital gain, which is 1.1 lakh. Now, 10.5 lakh rupees of gain in 2 years. You are happy, as I told you, but you have paid 2,10,000 in taxes in 2 years, which is net in hand is 8,40,000. Am I right?
Yeah.
Now, how the tax is levied, you need to understand that. So when I'm investing in PMS, because fund manager is buying and selling shares in my demat, okay, I have to pay short-term or a long-term capital gain accordingly. Now, let's say somebody has invested and you have invested instead of PMS into the mutual fund.
Yeah.
You have invested 50 lakh, same kind of a performance in your mutual fund. 50 lakh rupees of mutual fund after 1 year is 55 lakh rupees. You will not pay any tax because you are not withdrawing. Your NAV has increased. You will not pay any tax.
Yeah.
Okay. After 2 years, you want to withdraw this. And let's say from 50 lakh, your mutual fund portfolio has also become 60.5 lakh rupees, which is a gain of 10.5 lakh rupees in 2 years. Now, when you go and withdraw this 60.5 lakh rupees, the tax you will pay is 1,15,625 at 12.5%. Of course, you get that 1,25,000 benefit. And after considering that, to simplify, this is 1,15,625 tax. So in both the product, the gross return is same, which is 10.5 lakh. But effectively, after tax, in mutual fund, you have 9,34,375 to be precise in your pocket, which is 94,000 of extra return just by planning smartly. This is the disadvantage in the PMS. Again, I'm not deselling PMS, but I'm just making it sure that if you are investing in PMS, your return should be at least higher by 2-3% than the mutual fund. Then it makes sense, because the dividend you receive, Sharan, in PMS, that also taxable in your hand as highest rate, which is in your case 39%. So this is what I'm trying to tell you. In mutual fund also I get a dividend, but that is reinvested because
so I don't have to pay tax.
Of course. So the tax deferment people don't understand. And this is what exactly we are trying to make a point, that how you should look at post-tax return.
So basically, if you are investing in a PMS, you should at least get 2 to 3% higher returns than your mutual fund returns for it to
Then you break even.
That's when you break even.
True.
So if you're not getting at least 2 to 3% alpha, then that PMS fund manager is not doing a good job for you compared to a mutual fund manager.
Agree.
Right? And if you're going for a PMS fund manager, you're going for a higher risk strategy. So you better get higher returns.
Better return also.
Right?
True.
If you're getting same returns, then actually you've lost money compared to mutual fund
Perfect.
investing.
True.
Makes sense.
Glad you made it till here. If this gave you even one idea to improve your finances, send it to a friend. Helping them might just make you the smartest person in their group chat. And don't miss the full episode on Finance with Sharan. There's a lot more where this came from.